you are given a cash flow for the month of January to April. Now, assuming you are running a small business, if you have a small business that is running, it's very important that you maintain a healthy cash flow, because small business may not have the access to bank facilities, may not have access to bank loans, or even grants because you don't have any track record of your business. So you are very much dependable on your own cash. Now what we can see here is, I've given you the cash flow for January, February, and March. But the cash flow for April is left blank, now, which is what you're supposed to do. Okay? Now you can see that the opening cash balance in January is 25,000. Can you see that? Can you have a look there? 25,000. Now, during the month of January, you have a cash sales of 20,000 here. Can you see a 20,000 cash sales? Now, what is the meaning of cash sales? Cash sales means you sell and you receive the cash up front. Okay? So you don't have to have any credit liabilities, or you don't have to chase your customers for payment. But you also have credit sales of $76,880. Can you see that? $76,880. Now this is the credit sales receipt that you receive. Okay? But your actual sales in the month of January is not $76,880. Now let's look at the next page, on page 23. Can you see on top of page 23? Have a look at page 23 on top there. Can you see the month of January? Alright, can you see the month of January? Can you see the total payment for January? $76,880. Can you see that? Pay attention, huh? Okay. Now, the receipt from cash sales for January actually comes from the last 3 months credit sales. Now, in fact, in the month of November, your total credit sales is actually 74,000, of which you receive 12% of that, okay, which comes up to 8,880. Now, this amount you received in the month of January, but the sales was actually made in the month of November, because credit sales means that you sell, your customer will pay you sometime later, maybe 1 month or 2 months or 3 months later. In this case, the sales in November, 74,000, you receive 12% of that, which you receive in January. Okay, comes up to 8,880. Now let's look at December. Now in the month of December, your total credit sales is actually 80,000, and you receive 45% of that in the month of January, which comes up to 36,000. Can you see that? Alright, so part of the total receipt actually comes from November and December. And in the month of January itself, you have a credit sales of also 80,000, which you receive 40% of that in the same month, January, which comes up to 32,000. Now all these three amounts, 8,880, 36,000, and 32,000 are added all together, which arrived at 76,880. So in other words, what you receive in the month of January, the 76,880, actually are from the last 3 months credit sales, from November, December, and January itself. Okay? Alright, let's turn back to the main table on page 22. Okay. Now, in the month of January, you have an opening balance of 25,000. Your cash sales is 20,000. And your credit sales, the receipt from the credit sales, 76,880, which you have a total of 121,880. Okay. Now, with the 121,880, you make payments for purchases. Okay. How much is the purchases? 60,000. Payment for salaries, 9,400. Payment for fixed overheads, excluding depreciation, 25,000. So the total payment for the month of January is 94,400. Okay, what we do is we take 121 880 minus 94,400. We get a closing balance of 27,480. This 27,480 will be brought forward to the month of February as the opening balance. Alright, can you see the opening balance in the month of February? 27,480. Okay. Now in the month of February, we do the same process. Cash sales 23,000. Alright? And then credit sales receipt 81,600. How do we get the 81,600? Let's turn back to page 23 here. Okay. Now can you see on top of page 23 for the month of February? Okay. Now we have three amounts that we received. In December, our credit sales was 80,000. Okay, same like in the January calculation, 80,000. And we received 12% of 80,000 in the month of February, which comes up to 99,600. Now in the month of January, we have a credit sales of 80,000, which we received 45%, which comes up to 36,000. And in the month of February itself, our total credit sale was 90,000, and we received 40% of that, which comes up to 36,000. Now these three amounts, 9,600, 36,000, 36,000, we add up all together, we arrive at 81,600. So this 81,600 actually comes from the last 3 months credit sales. The customer are paying us in a staggered form on a monthly basis. Okay, now let's turn back to page 22. So in the month of February, our opening balance 27,480 plus cash sales 23,000 plus the credit sale receipt 81,600. We have a total of 132,080. Now with that amount, we are going to pay for our purchases 60,000. Salaries 9,800, and the fixed overheads 26,000. So total payment is 95,800. Okay, so 132,80 minus 95,800, we have a closing balance of 36,280. Now this amount we bring forward to the next month, March, as the opening balance. And the month of March, we do the same process again. Okay, until the end of March, we have $46,080. This $46,080 we bring forward to the month of April as the opening balance. Now let's have a look at the next page, page 23. Now if you notice carefully, we have a collection in the form of, in a certain pattern, 12%, 45%, and 40%. So it runs over and over again, 12%, 45%, and 40%. If we add up all the three percentages, how much do we get altogether? 97%. Why not 100%? So the company has actually made a provision of a 3% bad debts. Alright? Okay. Let's go through this. 3% of that debt is expected from experience. Okay, so that they expect from their experience, 3% of the customers are not going to pay that. So we have the 3% bad debts. And purchases are paid using 1 month credit terms. In other words, if you buy this month, you have to pay next month. Alright? And salaries are paid at the end of the month. So at the end of every month, you have to pay a salary to the staff. Let us assume that the credit payment trend will continue for April. So let us assume that our credit collection pattern will still be 12%, 45%, and 40% for the month of April. Okay? Now in the month of April, your cash sales is $10,000. Now let's look at the pattern of our cash sales. How much was our cash sales in the last few months? In the month of March, how much was the cash sales? 25. Month of February, 23. Month of January, 20. But now, in the month of April, there is a sudden drop to only 10,000. Now, how about credit sales? Our credit sale is 50,000. Now, let's look at our credit sales pattern. the last few months, how much was the credit sales? Month of March, 99,000, is that right? 99,000. Month of February, 90,000. January, 80,000. We had a high credit sales, but there is a sudden drop in the month of April to only 50,000. Now, the severe drop in the sales is due to the current health situation. Maybe you have SARS, or we